Imagine you are standing in a room with two doors. Behind the first door is a suitcase containing $100,000 in cash right now. Behind the second door is a single dollar bill, but with a unique catch. That $1 will magically double its value every year you leave it alone. Most people will instantly choose the suitcase because our brains are wired to prefer immediate, large sums of money. However, if you choose the second door and let that single dollar double just 20 times, you will walk away with over $1 million. This isn't magic or a financial trick. It's the raw power of exponential math. There's a hidden formula that can tell you exactly when your money will double anywhere in the economy, called the Rule of 72. Understanding how it works is the key difference between those who constantly stress over money and those who allow their money to work for them. To illustrate why this matters, consider the stories of two co-workers named Ethan and Maya. Both are 30 years old, work the same job, and earn the same salary at a logistics company. One afternoon, they both receive an unexpected $5,000 holiday bonus. Ethan is high energy and always looking for shortcuts to wealth. He decides that the only way to make real money is to constantly move it around. He uses his bonus to buy and sell high-risk tech stocks, trying to catch short-term trends. He believes that doubling his wealth requires doubling his daily efforts. Maya, on the other hand, takes a completely different approach. She understands that the secret to long-term wealth is not effort, but time. She places her $5,000 into a boring, diversified market index fund, sets up her account, and then forgets about it. She relies on a silent financial clock to do the work for her. The math Maya uses to predict her future is incredibly simple and can be done in your head in less than 3 seconds without a calculator. You simply take the number 72 and divide it by the expected annual rate of return on your investment. The result is the exact number of years it will take for your investment to double. For instance, if you invest your money in a conservative fund that earns an average of 6% per year, you divide 72 by 6. The math shows that your money will double every 12 years. If you find a stronger investment earning 9%, dividing 72 by 9 means your money doubles every 8 years. If you manage to achieve a 10% return, your money will double in just 7.2 years. This simple tool lets you examine any financial account, interest rate, or timeline so you can see your real financial future instantly. Let's explore how this plays out in the modern financial landscape with actual interest rates. Currently, a standard traditional bank savings account in the United States pays a national average interest rate of only 0.38%. If you apply the Rule of 72 to that rate, dividing 72 by 0.38, you will find that it takes 189 years for your cash to double. If you deposit $10,000 in that account today, neither you, your children, nor your grandchildren will live long enough to see that amount grow to $20,000. Fortunately, better options exist in today's financial market. If you transfer that same $10,000 into a high-yield savings account offering around 4% interest, the timeline changes dramatically. Dividing 72 by 4 means your money will double every 18 years. While this is a significant improvement, it still moves at a relatively slow pace. If you go a step further and invest in a balanced index fund that tracks the broader stock market, historically averaging around 10% per year when dividends are reinvested, the growth becomes more pronounced. At a 10% return, your money will double every 7.2 years. This means your wealth is increasing faster than the average person can climb the corporate ladder. However, the Rule of 72 has a dark, aggressive side that many people overlook until it's too late. The same math that generates wealth can also work against you to accumulate debt. Consider the average credit card interest rate in the United States, which currently hovers around 21%. If you carry a balance on your card and do not pay it off, dividing 72 by 21 reveals that your debt will double in just 3.4 years. If you owe $5,000 today and neglect to pay it down, you will owe $10,000 in a little over 3 years and $20,000 in less than 7 years. The financial system operates on the same principle regarding debt as it does for wealth, but with debt, the clock ticks much faster. To understand why the final years of an investment journey feel so much more intense than the beginning, consider a famous riddle about exponential growth. Imagine a tranquil pond in the countryside with a single lily pad floating on its surface. This particular species of lily pad doubles in size every day. If it takes exactly 30 days for the lily pads to fully cover the pond, which chokes out the water, on what day is the pond half covered? Most people instinctively guess day 15, assuming the growth follows a straight line. However, the correct answer is day 29. On the 29th day, the pond is half covered, and it takes just one more day, one final doubling, to fill the entire remaining half. The phenomenon described here is known as the lily pad effect, which illustrates why Maya's seemingly boring investment portfolio ultimately undermines Ethan's active trading strategy. Over a 30-year career, Maya invests $5,000 in an index fund that averages a 10% annual return. This consistent investment results in approximately 4 full doublings of her initial amount. In the first 7 years, Maya's $5,000 grows to $10,000. Initially, this growth may seem slow and unimpressive, leading Ethan to mock her for earning just $2,000 within a week by trading volatile stocks. However, let's observe what happens next. After the first doubling, Maya's $10,000 doubles to $20,000. During the third doubling cycle, her investment increases to $40,000. And finally, in the last doubling cycle, that amount explodes to $80,000. It's important to notice the significant shift in scale. During Maya's first doubling, she adds just $5,000 to her net worth. However, her final doubling adds a substantial $40,000 to her wealth. Both the time frame and the interest rate remain constant, yet the impact on her finances grows exponentially. This illustrates the crux of compounding math. Initial progress can appear minimal, leading many amateur investors to lose patience, abandon their investments, and sell off their assets. They mistakenly believe the investment is failing because they are caught up in the early stages of growth, but in reality, they are just at the beginning of the lily pad timeline. Significant wealth accumulation occurs much later. This principle illustrates how a small head start in life can create a gap that hard work alone cannot bridge. Consider Marcus and Chloe, who both save $500 a month in the same market fund with an 8% annual return. Marcus starts at age 25, while Chloe begins at 35. Although Chloe contributes $60,000 less in principal, Marcus ends up with about $1.4 million at age 65, compared to Chloe's $596,000. This $60,000 difference results in an $800,000 gap due to the extra compounding cycle Marcus benefits from. To protect against inflation, a silent wealth killer, understand the Rule of 72. It shows how inflation halves the purchasing power of cash. For instance, with a 3% inflation rate, living costs double every 24 years, meaning you would need $100,000 today to cover what $50,000 buys now. The Rule of 72 helps create a realistic financial timeline, allowing for a clear assessment of net worth and investment rates. Focus on maximizing doublings so your money works for you. Calculate your average return, know your number, and monitor your progress toward retirement. If you found this helpful, please like and subscribe and share your target rate of return in the comments. Thanks for watching.